I'm Tom Stelzer from Livewire, and joining me today is Adam Grotzinger from Neuberger to get their view on fixed income strategy right now. Adam, thanks for joining us.
Great to be here.
Adam, I think it's fair to say things are changing at a rate of knots at the moment, but what's your view on the macro outlook for the second half of the year? What do you think investors should be paying attention to?
Yeah, lots of things happening in markets right now. The big picture macro dynamics. I think just in the U.S. to start, growth is okay and actually quite strong. We're expecting 2 to 2.5% GDP growth in the U.S. Lots of contribution from everything happening in the investment side of that with AI, capital expenditure, but the consumers, also on reasonable footing. So the U.S. economy looks resilient and strong. Shifting to inflation, it's right. On inflation, we have I'd say a high conviction view that's anchoring a lot of our investment thesis that core inflation will be contained. Headline will be volatile given the direction of oil in a given day and the conflict in Iran, but limited pass through into core. The big disinflationary factors in core inflation are three things. The shelter component, so think about rentals in the U.S. continue to be disinflationary nature, and that's a big proportion of the core CPI basket. We also have wage dynamics, so services ex shelter, which are contained and controlled. So about 3.5% wage inflation historically relates to about a 2% core inflation, which is the Fed's target. And lastly, core goods. We had this period of tariffs, peak tariffs, in our modeling, as well as the Fed's own studies, happened in February of 2026 this year. So as we go forward in time, expect core goods prices to be, flat to maybe slightly deflationary. And so, it's a positive backdrop for inflation. And hopefully that data continues to play out as we push forward over the rest of this year. We've seen it in some of the more recent prints. So that thesis is working. We'll continue to observe it, but the right direction. And then lastly, the labor market in the U.S. I think last year it was clearly a softer labor market. This year we've seen some rebounding cyclically in labor. But our view is there's a lot to observe there. You can look at it as strong in some instances, weak in some instances. Our bias would be that labor has more propensity for softness and weakness. So think about a decelerating labor market versus accelerating labor market. And I think the construct of those three things means that the Fed can stay on hold here if that data is what plays out going forward, and the hiking that's priced in the market can maybe be taken out as we push forward through the second half of this year.
And how would you say all of that is shaping your thinking about portfolio position at the moment? What do you like the look of right now?
Yeah, so in particular, I'd say for that view on where the macro data is headed, we think that there's value in U.S. Treasuries, but belly to short dated type of maturities. So think about like 7-year and in type of U.S. Treasuries. Why is that the case? The market right now in something like a 2-year Treasury is pricing for 2 hikes. So you could say that U.S. Treasuries are cheap if you think that the Fed's going to be on hold and will not be pursuing kind of a renewed hiking cycle. Obviously, there's some volatility in that price action day to day, but we think that's an investment where if you give it the sufficient time, you're in a position of reasonable confidence that that's going to be a positive total return for the portfolios. But it's a contrarian bet given market pricing today. So we like those opportunities in the U.S. We also like complementing some of the government bond exposure with non-U.S. opportunities that just kind of have different reaction functions and drivers to them. So in particular, Europe, we see the construct of growth weaker than what the market's estimating. The ECB has hiked. And so we think there's some opportunities to own a bit longer duration in European bonds, and a similar kind of thesis in Canada right now. So, a combination of global exposures and high confidence in government bonds. And then complementing that, while we wait for some of the data to kind of prove out the pricing that government bonds could have, we think credit's a good place to invest in portfolios. In spite of richer valuations, there's good income, there's good carry. And so it's more of a portfolio management exercise of ensuring, the adequate kind of sizing of that, which is, I'd say, kind of moderate risk in credit versus kind of an aggressive stance given the valuations that we see today.
And changing tack slightly, I think AI obviously remains the dominant story in equities, but I think you've said it's increasingly becoming a fixed income story as well. How are you seeing things there, given the volatility and the, I suppose, sentiment shifts we've seen in recent months?
Yeah, that's right. There's been a pretty strong debt issuance pattern in particular from investment grade rated, we call them hyperscaler companies. So think about Amazon, Google, Meta, Oracle, even that are all investment grade rated corporations and bonds. It's been amazing this year. We've seen a huge deluge of supply coming to the market from these issuers. And what's driving that is this kind of constant revisions upwards of capital expenditure and really financing a healthy proportion of that from debt issuance, modestly from equities here and there we've seen, but a pretty heavy burden on borrowing in the debt capital markets to fuel these future capital expenditure needs. I think what's been interesting there is these companies are in a strong starting position, extremely strong. So many of them, for instance, negative net leverage or no debt on their balance sheets, but that's transitioning here over this year and over the next couple years with our estimations of new issuance trends to having modest leverage on their balance sheets from none, going from free cash flow positive for many of them turning to free cash flow negative. And the question mark, will all this spend be rewarded with revenue from the monetization of AI for many of these hyperscalers? And so that's something we're watching. I think those will continue to be the risks in these names that are tapping the debt market for their financing. And so the question for us as a lender to these, if we want to participate in their bonds, is are we being adequately rewarded for those tail risks and those kind of unknown factors looking forward? The start of this year, I'd say no. It wasn't clear that these hyperscaler investment grade bonds were cheap. They weren't cheap to securitize. They weren't cheap to kind of like strong double B credit. But we've seen a pretty big backup in spreads over the month of July in particular. That's created some better value here that's enticing for us, and we've started entering some exposure into the portfolio and hyperscaler debt.
And maybe just move into your funds now. I think duration in your strategic income fund has trended upwards since COVID. Is that something you see continuing?
Yeah, I think firstly, I'd say an interesting observation is we've gone since COVID from really like a zero interest rate era to kind of a higher nominal and real interest rate era. And so government bonds are no longer zero. In many cases, they're positive real yields. In the U.S., the 10-year real yield is a positive 2.5% right now, as an example. And so, yes, there's been kind of a renewed investment opportunity, given the volatility, given kind of the markets back and forth on what are the central banks going to do and how they're pricing that, to trade in government bonds, to have those exposures on an active basis, to exploit kind of extremes in pricing that the market may take at a given point of view. And so, yeah, since COVID and really since 2022 when the Fed started raising rates, we've seen that as a nice alpha source to complement what we're doing in credit, and it's been a pretty big contributor. In some years, 30 to 40% of the total return is coming from active trading of government bond duration in the portfolio. As it sits today, in something like strategic income, we've been managing kind of plus or minus a 1-year duration band in the portfolio, 4.8 to 5.8 years. We're around 5.5 years today, with about 80% of that in the U.S., as described, kind of 7 years and in on the Treasury curve, and complementing the other 20% of that in some of these non-U.S. rate markets where we see an opportunity to play for duration.
And I think you're also introducing a short duration fund. Do you mind explaining what the opportunity is that you've seen there?
Sure, yeah. So, we've been in market for a number of years with strategic income, as discussed. That's a fund that's flexible, but invest in bonds, maximizing return for investment grade risk, pulling on duration when there's an opportunity, pulling on, credit sectors and rotation and selection when there's an opportunity. The new product, we're launching in market, the short duration income fund, does everything that strategic income does in sector rotation, in security selection, as an alpha driver. But in duration, we're exclusively only focused on the front end of yield curves. And so its kind of constant duration is 2 years. And, we're seeing interest from some advisors, depending on how they're building client books and the client risk tolerance, that they like the credit exposures we have, they like our ability to select the right bonds, but they want to keep kind of the duration in a constant short duration structure. So, it's just appealing to kind of a different demand in the market and how advisors are building client portfolios.
And finally, I think we've obviously touched on it there, but I think government duration has actually been a detractor in 2026. What's the story there?
Yeah, the detractor is, look, government bonds, particularly U.S. Treasuries, have risen in yield this year, declined in price. So like the 2-year Treasuries, 70 plus basis points higher on the year. Given what we described at the beginning, where we see that the Fed's not going to hike, they're going to be on hold. That's our base case at about a 40% probability. We think there's some value there. The challenge is, building into that position in a contrarian fashion and risk managing it, understanding that there can be some mark-to-market downside in the near term. But we're okay with that contrarian positioning. The way, typically we've seen in the last few years in particular that, government bond opportunities exist is you can build into those on a contrarian fashion and adding. And when you get data that's supporting kind of the rallies in government bonds, they're often sharp and fast. And so it's often too late to be adding after you've observed the data. And so that's how we're thinking about the opportunity, which is, thoughtfully adding on a basis gradually into those opportunities. But that's been a detractor this year. Going forward, we see the upside to it, but year to date, it's been a detractor to performance.
Adam, thanks for joining us.
Yeah, pleasure to be here. Thank you.
Thanks for watching. For more great videos, make sure to check out Livewire's YouTube channel.